And thank you everyone for being here. It's great to be here in Auckland this morning and talk to some of our customers over here, and I really appreciate your attendance here. It's great to see so many faces, and I hope what we have to say is of interest. A lot of what I'm going to focus on is more Australia. I know that's a pretty important element of the global landscape for New Zealand, but I want to start with that more global picture. We all had big contractions during COVID and big bounce backs immediately afterwards. You can see New Zealand was a little bit different because it opened up so much later than everybody else, and those things are important, those details do matter. I think the main point I would make about this chart though is that there's a range of countries that are now seeing pretty slow growth. Tight policy really does matter. The US in red is the exception, and so I want to sort of emphasise that the ripple effects of COVID aren't over, and we are not the US and neither are you. The US is a bit of an outlier in terms of what's going on, and so one shouldn't map straight from what the US might be doing with, say, monetary policy to what might be happening here in Australia, in New Zealand or in Australia. Right around the world, we all saw a big surge in inflation. It was slightly differently shaped. In different countries. In Europe, you had that additional surge in 2022 because of the increase in energy prices when Russia invaded Ukraine. But all of that is now unwinding. And so the question is, where is domestic underlying inflation now, and will inflation get back to target? And I think the answer there is, in most countries, inflation is within striking distance of target. And over the course of the next few months, you'll see a number of central banks start to cut rates from their current restrictive positions. The European Central Bank, the Bank of England, the Bank of Canada are all expected to start cutting rates over the next few years. And in fact, Riksbank, the Bank of Sweden, has already started. Now, there are a couple of little exceptions to that, and the US, being a bit of an exception on growth, is also a bit of an exception on inflation. You've just seen it stall a bit. These are headline figures, but there is still a bit of impetus in domestic inflation in the US. New Zealand inflation's coming down. Remember, everyone else has monthly data, so the stair-step effect here is just because New Zealand, like Australia, has quarterly inflation data. It hasn't come down as far as some other countries, but remember, New Zealand opened up later. It is not as far on its disinflation journey. And when you saw that, growth is contracting, unemployment is increasing, we are seeing that downside track in inflation. And Kelly will talk a bit more about the New Zealand story. The common factor here is we all saw a big surge in goods inflation during the pandemic. Yeah, remember, we all needed to make a home office, so we all needed a computer and a desk. We weren't going to restaurants, so we were buying food at home, couldn't go to the gym, all bought an exercise bike, some of us are still using them. And so you had this surge in goods demand right at the very time that the factories making those goods were themselves locked down. So you had supply degraded at the same time demand surged, and so of course you saw a surge in goods prices, and that then unwound, and so most of that unwind has happened now. But services inflation had been suppressed because you couldn't go and do those things, and of course when economies opened up, services inflation picked up because it took a little while for the economies to stitch themselves back together. I mean, in a lot of countries, the restaurants closed, the people lost their jobs. It took a while to kind of bring everybody back to where they were. Australia, at least, and some, New Zealand being another one, if you had those sort of JobKeeper type programs where you didn't actually lose your job and you stayed connected to your employer, that came back a bit faster. But countries like the US took a while to stitch themselves back together. And so, services inflation was a bit later to swing up. You can see the swing up was more later in 2022. And you can see it hasn't come down as far. And again, there's a couple of countries where there's reason to be a bit nervous. New Zealand's one of them. The US, services inflation is actually remaining quite high, particularly around housing. And the UK, although its overall inflation rate's doing all right, its services inflation is not doing so well. And, there's a bit of a Brexit story there, but also if you look at, it was one of the countries that used to manage to have sort of above 2% inflation in services pre-pandemic. Whereas you look at Australia in the sort of orangey colour, actually, it was down with the euro area in terms of like quite weak domestic inflation. So the UK just seems to be able to be a bit better at creating some inflation domestically. So why has inflation started coming down? Well, some of it is just that unwind of the supply disruptions, but it's also because policy's a lot tighter and is weighing on demand. And so you can see that right around the world, but I'm showing the Aussie cash rate here and the Fed funds rate, you can see that interest rates moved very quickly a long way, and in many respects a lot faster than you saw, say, in the policy tightening periods of the pre-GFC period. So it moved very quickly, holding at the moment, and now the question is, at what point can central banks start to cut rates? As I mentioned, some other peer economies will be cutting rates quite soon. Because of the sort of later opening up and the sort of slightly disappointing trajectory in Australia, we don't expect the RBA to start cutting rates until November, and the Fed, we've got September in. But in both cases, the risks are to later rather than earlier. There's just kind of not enough time to get enough downside surprises on inflation to sort of push them to move any earlier than that. So that's where we think they'll be. And I think another important point about this graph is that we're actually expecting the Fed funds rate to stay above the RBA cash rate for the next few years. And if you look at the long end of the curve as well, so if you look at, say, 10-year bond yields or 3-year bond yields, that era between the global financial crisis and the pandemic, where a lot of major economies had zero interest rates for policy, that's gone. So we're just not going to have that big spread between yields in Australia or New Zealand versus, say, the US anymore. You can see how that gap between the red and the purple lines had sort of narrowed already in the years just ahead of the pandemic. And now, there's basically no spread at all. And, in some sense, the fact that the US is likely to have higher policy rates than the Australia for a while, that's sort of going to put pressure to have almost a positive spread on sort of longer range yields. Now, that's been the story for a few years, and so as a consequence, that's one of the main drivers of what happens to the exchange rate. As long as that story doesn't change, the overall picture for the Aussie dollar and indeed the New Zealand dollar doesn't change. There isn't going to be this big positive yield spread, and so you're not going to see a bid for Australian dollar denominated assets for exchange rate reasons because there's a yield pickup. And in fact, it has to be said that the exchange rate story has actually been a bit dull the last 10 years. If you look on a trade-weighted basis, which is the red or the purple lines here, whether inflation adjusted in purple or the regular one in red, honestly speaking, that's been pretty flat. It's been, other than that big spike down during the peak of COVID in March 2020, the exchange rate really hasn't done much relative to its history for about 10 years. And if you think about what's going on there, well, there hasn't been much move over the last little while in terms of yield spreads, so that story isn't changing. But also, although there's been big moves in commodity prices, people's beliefs about future commodity prices have not changed. Everybody still has in their mind, well, yes, we had that big mining boom. The Aussie dollar was really high then. That was when I was in Switzerland. Living in Switzerland actually didn't feel that expensive when I lived there because, the Aussie dollar was at parity with the US dollar and with the franc. Well, not anymore. I was back in Switzerland a couple of months ago and it didn't feel reasonably priced anymore. Just pretend dollars are francs. Just pretend US dollars are dollars. That feels a lot better when you go over there. So both of these are very expensive countries now for an Australian and presumably also for a New Zealander. But yeah, this has been a story of pretty flat exchange rate on a trade-weighted basis for some time. But of course, if you look at the US, the US dollar, it's swung around. And that's really talking about risk appetite. So on a trade-weighted basis, yield spreads and the beliefs about commodity prices one day coming down, those stories aren't changing. So on a trade-weighted basis, the story hasn't changed. It's unlikely to. But on a US dollar basis, there's an additional wrinkle, and that's risk appetite. When markets are risk off, investors want to be in the US dollar. It's their little safe haven. When risk appetite comes back and the market becomes risk on, well then that's a positive for currencies like the Australian dollar. And so at the moment we're in a bit of a risk off world. There's a lot of geopolitical risk out there. Markets are still sort of pricing in where they think, maybe there's going to be a recession in the US. They're a little bit nervous about all these things. And so at the moment, the US dollar is strong against everybody. This is a US dollar story, not an Aussie dollar story. At some point, and we don't think this is going to happen at least until after the Fed starts cutting rates and the US election has happened, at some point, risk appetite comes back, those uncertainties resolve, but that won't happen at least until the end of the year. At some point, we expect some upward pressure on the bilateral rate, but not a whole lot. I now want to talk a little bit more about policy and Australia, in particular fiscal policy. We had a budget, you had a budget, there's been some discussion about that. In Australia, I have to say the discussion was incredibly pessimistic. Oh my goodness, they're slipping into deficit. What a terrible thing after 2 surpluses. Pretty extraordinary outcome after having just been in COVID a couple of years before. And, some perspective people. Australia is the red line, US is the purple line. Yes, you needed to run a big deficit during the global financial crisis, and yes, you needed to run a big deficit to support the economy during COVID when you'd forced everybody to actually not be at work. But to spring back to 6% of GDP deficit, and let's be clear, it doesn't matter who wins in November, they're still going to be running profligate fiscal policy in the US. No wonder they can grow so quickly when they're throwing this much extra demand into the system. But this difference matters for the headwinds or tailwinds that the central bank is facing in its attempt to guide demand and get inflation down. So if you can imagine, the Fed is facing an extra 6% of GDP demand coming from the government deficit, whereas in Australia it's basically in balance. And yes, they did do a bit more spending, that's the green bit. So these are the variations relative to their mid-year economic and financial outlook at the end of last year. Yes, they did make some decisions around extra payments, particularly, we already knew about the tax cuts, but they're doing a bit more around things like subsidising electricity bills to keep measured inflation down. But you're also getting quite big parameter variations. You can see just how much in the current year, the year we're just about to finish, even since the end of last calendar year, in that 6 months, they've been positively surprised by about $11 billion. And that's purely the economy being a bit better than expected and commodity prices being a bit higher than expected. This is one of my favourite graphs in the whole pack. This is the iron ore price, and this really matters for Australia. I mean, I know, if we think about the linkages to China, we're very clicked into their industrial sector and their construction sectors, whereas in New Zealand it's really much more about dairy and the Chinese consumer. And of course, the Chinese consumer is not doing so well, but the industrial sector is where the government is very focused. And so, every year, Treasury forecasts that very soon the iron ore price will fall back to $60. And for the last many years, this has not been happening. But this is the sort of belief, even we think it's going to go back to $85. That's our forecast at the end of the graph. Even, the rest of the market thinks that too. This sort of belief is why the Aussie dollar doesn't go up when commodity prices go up, because it's not what's happening today that matters for traders' decisions about the Aussie dollar. It's something similar to the pink line. It's their beliefs about a few years from now. And the mining companies are not investing extra into these high prices because one day the Brazilians will start producing more. One day that facility in Guinea will come online. One day global supply of iron ore will expand. Just at the moment that the Chinese reach peak steel, which they already have. And so, there's just belief that there isn't any upside in iron ore. This is as good as it gets in terms of production. And so everyone expects the price to fall one day. And so far it doesn't happen. And for every quarter that it stays above $100 instead of going down to $60, that's about $4 to $5 billion Australian extra revenue every quarter. So, if iron ore prices actually stay, they don't even do what, if they stay above $100 US per tonne, that $23 billion deficit that the federal government's projecting could go very close to being a surplus just from this alone. Okay, so it pays not to get too despondent about the fiscal position in Australia, because those pink lines are pretty, for very good reasons, deliberately conservative. That's the game we play with fiscal policy in Australia. One of the other games we play with fiscal policy is we subsidise electricity prices in order to lower measured inflation. Now, the dark blue line, smooth line, is what was in the budget forecasts. The green line is what our team at Westpac Economics guesstimated the government, the forecast based on our guesstimate of what we thought the government would announce in the budget. In the private sector, you're allowed to make that guesstimate of unannounced policies. The convention in the RBA is they only factor in announced policy, announced fiscal policy, announced measures. So they didn't have additional, they assumed in their forecast in May that all the electricity rebates would roll off, and you just kind of knew that wasn't going to happen. And sure enough, the government deliberately structured things so as to say, hey, look, inflation's going to be back at 3%, at least on a headline basis, already by the end of the year, and you're not expecting to get back to the band until the end of next year. So, don't you be raising rates now. Don't you be raising rates. And you can see how the government structured things, because the last thing the government wants to do is to go to an election with rates having just increased. They want to be able to go to an election having just delivered a tax cut to almost every wage earner, and hopefully 1 or 2 rate cuts. And to be able to say, look, we know it's been a really tough time, but the government did the hard yards and now we've delivered, and please re-elect us. This is the game that we're playing with fiscal policy. One of the things that's going to make it hard, though, to actually achieve those sort of results is that where the inflation remains is in the hard-to-reach areas. So this is a really nice way of looking at Australian inflation, because if you think of discretionary, furnishings, clothing, but also a lot of holidays, personal services, pets, those sort of things. Pets are not discretionary, sorry. I have 2 dogs and 2 cats. It's like peak pet at my house. But you can see that, we had this period of inflation undershooting target pre-pandemic, but if you think of where, discretionary inflation is well inside the target now, particularly excluding tobacco. So that green line sort of saying, look, the bit that is most sensitive to people's reactions to interest rates, it's already there. But we've got this really awkwardly high non-discretionary. And you think about what that is. It's things like rent, it's things like healthcare, it's things like electricity, things I've already mentioned. And so that's the hard to reach places. And realistically, monetary policy doesn't really directly affect those prices. All they can really do is get the green line down even further so that the total of the two is in the target. That's going to be the game they're going to have to play. We've got the April numbers. We don't have a full CPI monthly yet, but we will next year. But it's each sort of month, each quarter or so, they add a few more things monthly. It's getting better and better. We will have a full monthly CPI by next year. But comparing year-ended to April this year in the red bars to the previous year's inflation by category, which is the little purple blocks, you can see a really important pattern. Last year, there were 2 cases of low inflation and everything else was well above 4, actually almost all of them were 5+. Almost everything was 5+. Roll forward 1 year and you can see that that is starting to normalise. We do still have high insurance inflation. That finance and insurance is mostly insurance. Alcohol and tobacco, that's mostly driven by tobacco, like that's completely policy driven. Health insurance has gone up, a lot of other sort of doctor fees, again, largely administered. Education, largely administered. So the 4 biggest categories now have been really driven by kind of government policy and a legacy of tending to index. So last year's high inflation smears into this year's inflation because of indexation. You have these parts of the basket where this year's price increase is determined by last year's CPI. And this is one of the reasons why I've publicly advocated that we should stop doing that and instead just increase those things by 2.5%. which is the midpoint of the RBA's target. We should stop doing, if we really think that the economy is going to be subject to more supply shocks from now on, if we really think that the geopolitical risks make the world more inflationary, well, we should stop doing things that perpetuate inflation dynamics into the next year through indexation of administered prices. But I do think, I think this is very compelling. It shows you, recreation, household equipment, both very much discretionary. Communication actually has ticked up, but it's pretty, is low. Clothing and footwear hasn't, is one of the few things that was low before. Food and beverages has come down. Transport is still high, but has come down. Housing's a really interesting one. I'll firstly just show you just how shocking insurance inflation is in Australia. Total inflation is sort of in the threes on a headline basis. Insurance costs up 15% over the year. I had the very awkward position of when the March quarter CPI came out. That afternoon I was actually giving a presentation at an insurer customer. And so I showed them this graph and I told them they were part of the problem. And they nodded their heads and ruefully and said, yeah, we are, but, building costs are up and, healthcare costs are up and, all of these things and, climate change, we kind of have to do this. Insurance costs have tended to outstrip the CPI for forever. And I think this is one of the things I think we'll have another look at over the next few years because I think there's a real story here. I also mentioned housing. We met with some building and infrastructure related customers this morning here in Auckland, and I think this is a very similar story that you would have heard in New Zealand. Building costs have gone up a lot. They're still increasing here in Australia, and I believe also in New Zealand, running at 5%. It's come down from over 15% to just sub 5%. Interestingly, residential building costs have actually gone up by more than non-res. And that's despite the fact that part of this is because of the bid from infrastructure. A lot of the state governments are spending a lot on infrastructure, as well as all the kind of COVID-related supply chains, and we can't get builders, and some of the builders went bust because these costs went up, but then they had fixed price contracts, so they went bankrupt, and that actually shrunk the sector a little. All of those things are happening. And so what that means is that even though at the moment the flow of new housing starts is actually quite low, as you'd expect given where interest rates are, there's this huge backlog. So that's the red line. There was a spike during 2021. One of the things the government did in Australia was during COVID, they had this program called Home Builder, where you got a government subsidy if you signed the building contract before a certain time. Now, the iron law of time-limited subsidies is you end up paying more because everyone rushes to get the subsidy, and the price goes up underlying price goes up by even more, and you actually end up paying more than if you'd never had the subsidy. Sorry, it happens every time. It happened with pink bats, it happened with, solar panels. It's the iron law of a time-limited subsidy. But what it did do is it built up a new backlog of homes under construction. That's the dark blue line. And you can see that, the work being done is still really low, completion rates are really low, and that backlog is taking a really long time to work down. And so it's just getting really hard to get stuff done. Builders have gone bankrupt, you've got to find a new one. Now is not the time to be doing a renovation in Australia, let me tell you, and fortunately I'm not. I did that 9 years ago and I am glad, because I would not want to be doing it now. So, some of these frictions are some of the things that are holding up home building costs, which are in the CPI, holding up rents as well. I want to talk a bit about the consumer briefly. I didn't put New Zealand on here, but New Zealand looks a lot like Canada if you put New Zealand on the graph, so that gives you an approximation. Australia is an outlier. Household consumption per capita has been declining consistently for more than a year. We will have another data point on that tomorrow when the national accounts come out. The US is the outlier. Look at that green line. The US is the one where the consumer is going gangbusters. Totally different from the rest of the world, as you'd expect given what's happened to GDP. So why has Australia been such an outlier on the downside? Well, the answer is because they've been copying it from all sides. Yes, interest rates have increased. That has dragged a little on income. You can see that in the purple. And of course, people do, even if their incomes don't decline, they have responded to high interest rates by, saving more and spending less. That's economists call that intertemporal substitution, but that's just basically saying it pays you to pay off your debt faster when interest rates are high. Blindingly obvious, really, if you think about it. But I think the surprising thing about this graph is that actually the effect of monetary policy directly on household cash flows has actually been pretty small. The bigger drag has actually been tax, and this story will resonate here in New Zealand as well. Inflation's even though labour markets have been strong, labour incomes have been growing a lot. That's the light blue bit. The pink bit, inflation, has been sucking a lot of spending power out of the household sector, and the drag from tax has sucked out almost as much. Much more than monetary policy has. Fiscal policy has been a bigger drag. And you can see this in this graph, which shows the share of household income going to income tax. And you can see how that's escalated, particularly during the COVID period when inflation was high, but also beforehand. Why? Because the tax brackets are fixed in dollar terms, unless you do something about them. And that's true in New Zealand as well. You have this, it's like people say, well, how are we going to fix our fiscal problem? The answer is do nothing and let fiscal drag take care of it. It feels a bit untidy, but that has been the game that Australian governments have played. And it's like you get to a point eventually where you say, okay, we'll give you a tax cut, aren't we lovely? Again, I have advocated actually escalating tax brackets by 2.5% each year to avoid some of this problem, but of course no government's going to do that because they like saying, look, we gave you a tax cut. No one's going to make that automatic, but it would be a better system. But either fixed tax brackets or 2.5% escalated brackets would be better than what the US and Canada do, which is CPI indexing. Because guess what? That means that fiscal policy isn't even touching the sides on the household sectors in those countries. They are not seeing this incredible escalation in the tax take. So no wonder the US is running such a big deficit. They're not seeing that increase in tax. And, you're not leaning against high inflation when you're indexing for CPI. If you indexed at a fixed rate, you would still lean against high inflation with fiscal policy, but not if you CPI index it. So that's just something to bear in mind. Something both New Zealand and Australia have experienced is very weird population shifts because of COVID. The ripple effects of COVID are not over. We opened our borders. Well, we closed our borders, population growth went down, that's the purple line. And then we opened them up again, and an awful lot of them were students. China opened its borders as well. The Chinese authorities told their citizens, hey, if you want your overseas degree to be recognised back in China, you now need to go and study in country. So what happened? They all turned up for first semester last year in a rush. And you see that in the purple line. That purple line only goes to September quarter last year. It's quite a lagged series. And there isn't a construction industry in the world that would have been able to pivot that much to suddenly start building 50% more housing in a year. And so rents have gone up. And so have house prices, particularly in some of the smaller cities. Affordability constraints are really causing things to top out a bit in Melbourne and Sydney. But in Perth and Brisbane, you're still seeing very strong growth. I'm going to close off with some discussion about the labour market. It is a somewhat different story to New Zealand. Unemployment rate is picking up now. It's been a bit volatile lately. There's been these sort of things about people who've got a job but haven't started it yet that's throwing some sort of noise into the monthly figures. You won't even see it. Your labour market data are quarterly. But I think the important point here, I'd make two. One is the idea that there are labour shortages in a country where the participation rate is at an 114-year high, and yes, I know because when I was at the RBA, I got the team to go back through the dusty yearbooks. You can actually get a participation rate going back to 1910 in Australia. But because ageing of the population, people used to think that meant that our working workforce would shrink. No, it doesn't. It means people are living longer, healthier lives, and fewer people retire early due to ill health, and more people work past standard retirement age. And so you see participation rates go up for that reason. Also, population ageing happens partly because we have smaller families, and even if we're in a world where mum stays at home with small children, if you're having smaller families, you're doing it less often. Female participation and older worker participation have gone up a lot right around the world. US is a bit of an exception, but you look at most industrialised economies, you see something like this. and it is driven by female and older worker participation. So plenty of labour supply, not the bottom of the barrel. Experienced workers and mums, people who know what they're doing, not marginal workers. So if anyone thinks that the marginal worker thing is the reason, tight labour markets driving low productivity, I don't buy that. Employment to population obviously has therefore also been at an historic high. Unemployment, it got to 3.5% for a while. The last time unemployment was at that rate, I was in preschool. Yes, it's going to get back to, we think, about 4.5% as the economy eases. But put that in perspective, that's still better than almost all of the last 40 years. So the RBA has a clear strategy that they're wanting to preserve some of these gains. Most other countries they got back to where they were in 2019. Whereas, in Australia, 2019 wasn't a great time for the labour market. We've gotten well below where we had been. And so the RBA has chosen a deliberate strategy of trying to stay in this new world. And they buy the idea that if someone gets a job, they become more employable later. There is a path dependence to what sustainable unemployment is. And I think New Zealand as well would have experienced that. Back when I started at the RBA, which I'm going to tell you was here, right? I was one of the refugees from the Melbourne recession. People thought that the best you could do was maybe 8, maybe 7. I remember being at a meeting at the Bank of Canada in 2000 saying, oh, look, if unemployment goes down much below 6, I'll eat my hat. Fortunately, I didn't have a hat because that would have been very hard to digest. But, great outcome for Australia. Probably made me look a bit silly if they'd remembered I'd said that. But it just shows you that unemployment is path dependent, and the RBA does want to lock in some of those gains to the extent it can, and consequently it is choosing a somewhat slower return of inflation to target than some other countries. And they're being supported in that because we can see, the labour shortages are easing. This is the most ridiculously good correlation of any graph I've ever shown in my career. That the purple line is a business survey, the NAB business survey, share of firms saying that employment is a constraint. And the red line is the ABS job vacancies data divided by ABS unemployment rate. So 2 surveys going into the red line and a third completely separate survey going into the purple line. That correlation is stupidly good, isn't it? Yeah, you're all nodding. But it's telling you that you can be reasonably confident from 2 completely separate sources that there had been labour shortages, things had been really tight, but now it's unwinding. And given that, you can be reasonably confident that wages will start to unwind as well. You would have seen yesterday that the national wage case came out. That only covers a relatively small proportion of the labour force, but it does tend to have a bit of a start, a bit of a signal for the rest of the labour economy. We've already seen wages growth peak, and that result, that 3.75%, was a little bit lower than what we were expecting. And so that just gives us more confidence that labour costs are coming down, domestic cost base is coming down. The RBA will be able to see inflation coming down more or less on track. There are potentially still bumps in the road, but we do think they're on track to the next move being a cut, and we think that's going to be November. So I might hand over to Kelly now to talk a little bit more about New Zealand. Thank you very much.
Thanks very much, Lucy. Last Friday, Lucy wrote a note talking about the grumpy hawk. And I fear you'll get a little bit more of that sort of story coming out of the New Zealand story that we've got to talk about here now. So what am I talking about here? Well, you might have noticed that the big theme of our QEO this time was the idea of the hard yards. And we think it does encapsulate pretty much where we think the New Zealand economy is going to be over the next 6 months or so ago, where in many respects the economy will feel quite hard for a lot of households and businesses. So we're in a situation where growth is basically flatlining to going backwards a little bit. The unemployment rate is rising, so increasingly households are going to notice that it'll be the labour market that will be taking a greater share of the adjustment than perhaps has been the case in the last year to 18 months or so. But at the same time, inflation still remains persistently, stickily high, and we've got a grumpy Reserve Bank governor down in Wellington whose job depends on getting that down, telling us that interest rates are just going to have to remain at these sort of levels for as long as it takes to get inflation back down to 2%, which is really where he ultimately wants to see it go, and certainly below 3% in relatively short order. So, this is a picture where basically the economy has to do the hard yards, a bit like in the old days when you did your netball or rugby training session. The coach is going to be yelling at you and screaming you at the background. The legs are going to be screaming, the lungs are going to be screaming, just so that you can ultimately get to where the coach ultimately wants you to be. In terms of the GDP outlook, the growth outlook, you'll see that it's not that flash, really. I mean, basically, we think the economy is going sideways now. The first half of the year, I think we're not really expecting any growth of the economy, and maybe the potential of some kind of modest pickup as we get through the second half of the year. That's in absolute terms, but obviously in per capita terms, because we've got that very strong population growth that Luci was discussing about in the context of the Australian outlook, per capita growth is sharply negative, and indeed is as negative as it has been through any periods of quite significant recession in the last 20 or 30 years. That's why, I think for a lot of individual businesses and households, this really does feel like a pretty bad recession, even though in aggregate the economy is really just flatlining at relatively low positive levels. We do anticipate that there is going to be a pickup as we get through the back half of this year and into next year. A couple of key factors to keep in mind there. One is that we do have some tax cuts hitting the economy from July 31. That was one of the outcomes of the budget next week, so we anticipate that people are going to spend at least some of that. But also as we get through to the end of this year, people are going to increasingly be looking forward to interest rate cuts, which we have in the forecast from February next year. So there'll be some respite in there for households from relatively high interest rates. In aggregate, though, that growth profile is not that flash. It's basically about a third or just a shade under the third of the growth profile that we got used to for those 10 years or so before COVID. You don't have to look very far in the economy to see signs of economic stagnation, weakness. Certainly in the business sector here, this is one of our better indicators, these purchasing manager indices, and they indicate that growth is basically rolling along at about zero. The services sector is doing a bit better than the manufacturing sector. That's a theme that you see through most economies around there. So it doesn't really look like in the here and now things are particularly changing that much, which is fortunate, because if I look at our forecast for growth the next couple of quarters, I think we've got a plus 0.1 and a minus 0.1, which is good as zero. In the way that we understand the precision of this stuff. It's also very apparent when you look at the retail sector. This is a pretty strange graph, this one, because usually the red line, which is real retail trade, it tends to trend up, just at different paces depending on how good the economy's going. The pretty weird thing you'll see here is it's actually been going backwards for, I think, 6 quarters. Last week we got a small positive increase for retail trade in the first quarter, first one in, as I said, about 18 months. So that's just an indication of the pressure that households have been under, as well as there's been this shift away from goods and into services that have gone on this post-COVID period. It's not like that it's costing any less money, though. The top line there is the nominal retail spending amount, and because we've had quite a lot of inflation, it means you've basically had to spend more money to get the same amount of stuff. On the business side also, another consequence of this relatively weak economy is that profitability is very weak out there at the moment. And the thing about profitability is it tends to drive investment decisions of firms. So we're definitely in the down cycle for the investment cycle, and we would anticipate that will be continuing sort of as we go through the balance of this year, with ultimately a pickup next year as business conditions start to improve. And the culprit really driving a lot of this is what's been going on with monetary policy. You probably have seen this chart a few times before. It basically just plots what interest rate households are paying on average as they've been rolling off those lower fixed rate mortgages onto to higher rates consistent with the current OCR. It is one of the differences between Australia and New Zealand is that we have predominantly fixed rate mortgages here, so it takes a little while for the flow through to occur. And you can see here that the gradient of that line going from sort of February 2022 to now, pretty steep, right? That's a lot of money that households have had to find in relatively short order to continue to pay the mortgage. The good news story is that we're pretty close to the top of the hill now. So whilst there is a bit of extra cost to come out of household budgets, it's nowhere near the pace of what we've had to deal with in the last 12 to 18 months or so. Looking forward, we anticipate that house prices are going to continue to recover, but slightly above inflation levels, but not particularly stellar ones. There's a few push and pull factors sitting in here with respect to the housing market. The push factor is that we've had this very, very strong population growth, 3% in aggregate. You have to go back to the Second World War to see those sorts of numbers in New Zealand. And it has driven demand for housing. You can see it most tangibly right now in the rentals growth, which rental inflation is sitting at 4.7% per annum, which is as strong as it has been since 1999. And we expect that as we go through this flatter period in the housing market that we're seeing now to the second half of the year, as those interest rate cuts get a bit closer, and as the investors that got some improved treatment of their tax treatment on investor housing, that we will see a bit of a pickup in the property market, reflecting the fact that that demand for housing is going to be with us for a while. The thing that's really leaning against the housing market right now is the level of interest rates, which is making it quite difficult for most people to really contemplate a large value purchase. And I would say that if I think about, it's very much the interplay between these two big offsetting factors. If we look at historically the relationship between migration flows and house prices, we see a fairly strong relationship with about a 1 year lag. Thinking back to when migration really took off here last year, it basically means that we should really be starting to see that peak impact coming through about now. If you just took that really big increase in population growth we've seen at face value, you might be asking yourself why prices weren't going up at 15 or 20%. And the answer to that is that Adrian Orr and the Reserve Bank have really been leaning against that to try to slow the economy down. So this gets us to the first question of the thing, which is basically, what do we think the labour market's going to do this year? I'm going to take you through our labour market view in a minute. It's pretty important in terms of how we think things like the economy and inflation are going to adjust over the course of this year. If you look on your Slido thing on your phone, you've got some 4 options there to pick from. Tell me what you think. You think the unemployment rate's going to remain around current levels, rise a bit, rise a lot, maybe more like the GFC experience? Will stay around about the same level? All right, so we've got 80 odd responses there so far. It looks like we've got probably the largest group of people expecting something in the order of a modest increase. So if I move on to tell you what we think that that's probably not far off from the mark. So our labour market view here is that we are going to see that slower economy be reflected in a weaker labour market. It has been going on for a while and it will continue to be the case. Basically, we anticipate that the unemployment rate will move from the current 4.3% up to about 5.2% by the end of the year. And then move down. So, and at the same time, we'd expect that to be associated with a reasonably significant deceleration in wage growth. One of the things that's had a particularly significant impact on inflation, we think, in the last while is that wage growth has been fairly elevated. In labour cost index, so like productivity adjusted terms, it's been sitting over 4%, and really it does need to sit closer to 2% if you want to see inflation at target. There's plenty of risk around that though, in both directions I would say. One of the things about this labour market is that it has surprised everybody, including the Reserve Bank, in terms of how resilient it has been, even though interest rates have gone up a fair way. This graph here just shows you the evolution of the Reserve Bank's own unemployment rate forecasts over the course of the last year or so. The key theme there is that they have been surprised at how low the unemployment rate has remained. It's just starting to step up now, but it would be fair to say that by New Zealand standards, if we get through this cycle with the unemployment rate peaking maybe in the 5 to 5.5% range, that won't be a bad outcome in terms of thinking about the concept of a soft landing. Fiscal policy. News of last week was the fiscal stance, and I think the thing there is that whilst the government retains optimism that they will be moving back to surplus by about 2028. It's going to be a pretty long hoe to row to get there. Interestingly, when we saw the Treasury's revised forecast last week, they did actually deteriorate, reflecting the fact that the government has pretty much delivered on its tax cut and spending initiatives that they promised, but it's come in the context of a weaker economy and a weaker revenue outlook, so they've had to borrow a bit more to be able to do that. And as a result, according to the Treasury's figures, fiscal policy probably isn't really restraining the economy at all in the coming year, even though it was expected to be a contractionary factor. That's one of those things that probably the Reserve Bank isn't that happy about, and indeed was probably one of the reasons why they came out a little bit more hawkish in the last little while. Our forecast is that after a couple of years of ongoing spending restraint in line with what we saw in the last year, it'll be probably increasingly harder to maintain that pace. Hence, we suspect we'll be looking at deficits for a fair while. And the implications of that is, if you look across countries, there does seem to be a decent relationship between the countries that have had more expansionary fiscal policy through this kind of COVID period and those that have had higher inflation. I mean, the United States is a little bit of an odd one out there. They've got a very large structural deficit and inflation is only slightly elevated. But if you look across the other group of countries, you can certainly see the delineation between countries like New Zealand, Japan, Norway, versus countries like Canada, Switzerland and Sweden, who either have cut rates already or probably will do in the very short order. One of the challenges that we've got here in New Zealand is that between fiscal and monetary policy, it really did light a fire under this place over the last 5 years, and we are still living with that in terms of elevated inflation now. Which gets me to my second question, which is what I'm supposed to be doing, is like, what do we think inflation? When do you think it's going to return to 2%? It's currently sitting at 4%. Do you think it'll get there, 2025, sometime in 2026 or later? Do you think it'll ever get to 2%? Oh, numbers are still going up. It's looking like a bit of a foot race here. Interesting. So we've got sometime before the end of next year and then sometime in the second half of 2026. That's a fair range. That indicates a degree of uncertainty. I think that's probably fair when we consider what's kind of going on out there. So if we move on, In terms of our view about what's going to happen with inflation, we think it is going to gradually track down, but it is going to take a while to get to 2%. We think that at the end of this year, inflation will be about 2.9, which is pretty much in line with what the Reserve Bank currently forecasts. But getting all the way down to 2% is a much longer term endeavour. The Reserve Bank has actually just pushed out its expectations to that it thinks it'll get there sometime in 2026. Actually, our forecast suggests that we may not make it. That as we actually get down within the target range, there'll be less imperative to continue to push inflation down. And the problem that we've got here is that even though tradables inflation, think about it as imported inflation, is basically normalised now that all of the supply chain issues have washed through the economy. That services sector non-tradables inflation that is quite driven by labour costs continues to be relatively high and is falling only relatively slowly, and hence that's why, if we think about the risks around our inflation forecasts, the evolution of non-tradable inflation we think is very important for how the Reserve Bank sees things over the balance of this year and into next. Right now our forecast is that they should be comfortable by the start of next year to start cutting, because by then they will have seen perhaps 2 or 3 reasonably good CPI outcomes that will be giving them confidence that whilst they won't be at 2%, they'll have confidence that they're going to get there. But they have been consistently wrong on this one in the last 3 months or so, and they've noticed it and they're not happy about it. And that's one of the reasons why they came out relatively hawkish in the last monetary policy statement. So I think this is probably my last question, but it's quite an interesting one. Which central bank is going to ease first? Adrian, you're struggling to catch up. Well, I think this is good news, Luci, because I believe that's the House view, right? So yeah, I mean, it's not a straightforward question to answer, to be honest with you. I mean, there is a bit of a view out there in the United States they might not ease this year. Luci's, the Australian team seem fairly comfortable that given inflation trends that the RBA will be in a position to do something next year. In terms of our view in New Zealand, it feels like November is about as early as you could reasonably rationalise an easing, and the core view is really it's more like February before they'll have that sort of confidence. And I will warn you that the Reserve Bank's own forecast really suggests it's more like August next year before those rate cuts happen. So we'll have to see how this pans out. These expectations have been moving around significantly. 3 weeks ago, I did a wholesale customer survey asking this same question. Our wholesale customers were all very confident that interest rates are going to get cut in New Zealand either in August or November 2024. And that is no longer, I think, their view now. With that, I will pass it on to my colleague Imre for some strategy.
Thanks, Kelly. Our forecasts for the very near term, like these Luci and Kelly talk about forecast years ahead. I don't dare go there with markets. 3 months is about as far as we'll go. But so this is really multi-week, multi-month. Kiwi higher against the US slightly, Kiwi higher against the Aussie dollar slightly. For interest rates, short-term interest rates, within the previous range, but closer to the bottom of the range rather than the top, so with a bit of a downward bias. Not so much the long end, which means we get a steepening of the yield curve. Now, just to substantiate some of that stuff, starting with the Kiwi US, the previous 3 months when I was up here, we thought we'd get a rebound of 59 cents and it would head towards 62. And that's pretty much what happened. So happy with that one. From here, I think we have a go at that 62, to be more precise, 62.20, which is a recent high. And if you break above that, then I think you could be looking at 63.50. But you really need to break that 62.20 mark first. Of the many things that are driving this, apart from just where the US dollar has gone, and very recently it has weakened a bit, Interest rate spreads, still a very important determinant of interest rates globally. Interest rate spreads become much more important post-COVID than in the normal times pre-COVID. I think one reason just because the cycles have been so big. Anyway, interest rate spreads, very important. You can see that they fell quite a lot against the Kiwi over the past 1 to 2 years. And it seems to me that they're starting to find a bottom. And there's not much of a spread there now, but it is poised to rebound. And even small movements upward would drive the Kiwi higher. In addition, commodity prices, they have done quite poorly over the last, well, I'll call it 9 months, year. But in very recent times, they have rebounded and they're looking promising, at least for the near term. So they will matter maybe at the margin. And then if you collect all of the stuff that usually drives an exchange rate and throw it into a fair value model, you get 63 cents. Now, in reality, you hardly ever sit at fair value, you deviate, but what it does at the very least, it gives you a bit of a bias or an anchor in one direction or another. In other words, gun to your head, if you knew nothing else, you'd rather be a buyer of the Kiwi rather than a seller of the Kiwi presented with this information. On to Kiwi Aussie. Last time around, we thought we'd get a fall, we did, and for the next 3 months, it's the opposite. We think we'll get a rise. And why is that? Again, it's a yield spread story, probably more than anything else. Yield spreads recently look like they found a low. They've been quite volatile, but I think they are heading in an upward direction. Now, market pricing for these two central banks is what's at play here. Market pricing for the RBA does look like it's too high relative to Luci's November forecast for a cut. On our side, it looks like it's too low relative to Kelly and team's forecast for February. So if both of those kind of panned out, then you would get this yield spread moving up in the Kiwi dollar's favour. Also, maybe at a pinch, the commodity story. Very recently, iron ore has started to pull back a bit, and that might become an increasingly feature of the cross as well. So higher for the next 3 months, Kiwi Aussie. On to interest rates. Last time around, I thought downwards would be the direction, and that was not true. It really just ranged sideways. I think we'll get a similar range for the next 3 months, but with a tendency to test the bottom of the range. So the very bottom of the range is about 460 for the 2-year swap. Market pricing now is not too far away from, say, the Westpac view. If you go back 3 or 6 months, it was very far below. So they've come up close to it. They're fully pricing the first rate cut to be November. Now, markets, interest rate markets, that is, have an ingrained bias to bet on rates falling rather than rates rising. Also, there's an asymmetry where the next move is going to be a rate cut, not a rate hike, probably. So markets, knowing all this, are going to be predisposed towards pushing rates down whenever possible, and a reluctance to pushing them higher. So I think from this level where they're kind of in balance, I think the asymmetric risk is that they can fall from here if they get evidence like data and such which fits their view. And you are going to get that over the next 3 months. You're going to get good data, bad data, but I think they're going to move more on the bad data and push rates lower rather than the opposite. And this waiting period ahead of the first rate cut is going to be the longest ever in New Zealand OCR history. So we've just beaten the previous length, which was 12 months. You can see those grey bars are all the past OCR cycles between the last rate hike and the first rate cut. The previous record was 12 months. We're already at 12 and a half. And if Kelly and team are correct, then we're going to be going 23 months waiting for the first rate cut. So extraordinary stuff. What happens during long waiting periods? Markets just get really jittery and volatile. Now, volatility is not a bad thing. It can be your friend. So depending on what you want to do, if you want to pay, if you want to receive, if you want to buy Kiwi, sell Kiwi, all those sort of things, volatility is great because it presents you with an opportunity regardless of your view on markets. So that's coming ahead. And I'll just finish up with a picture here which effectively gives you a fair value for swap rates out to 5 years, taking Kelly and team's forecast for the OCR, converting that to fixed rate swaps, those are the red bars, and lined up beside them, the grey bars are the actual swap rates prevailing. At a glance, you can see they're not a million miles away from fair value. If you look real close, you can see that the 1 and 2 year are slightly below fair value, whereas you go out to 5 years, they look like they're a bit rich compared to fair value. How do you use that? Well, I'm not going to go any further because that'd be giving financial advice, but depending on whether you want to fix rates or unfix them, you could perhaps use this to your advantage. So I'll close it off there, and thank you very much.